Hello and welcome back to Principles of Accounting 1. I am still your host, Dr. B. Happy to have all of you with us today as we explore the concept of accounting for receivables. Just before we jump into today's discussion, I want to point out where we are in the classroom. Here in the classroom, we are in week 5 already. Oh my goodness, week 5, if you could believe it or not. So last week, we had the midterm exam. The midterm exam, I think overall went pretty smoothly. There were a couple of hiccups here and there, of course, but overall, the overall performance, I was quite happy to see. Yeah, it was a tough exam. It included the first 4 weeks of the course. It was very detailed. There was some math involved. There was a lot of questions, and hopefully you had the chance to review before you took the exam. It was a lot of work. I know it really was, but I just want to say thank you to all of you for your hard work in the class so far. I know it's not easy. You got work, you got school, you got family, and of course you got me. Right? Like I'm the fourth wheel in your life, right? You're like, oh, that Dr. B, oh, he makes us do so much work. I know. Yeah, I'm the fourth wheel in your life. I'm the person you save the seat at the table for at dinner time. I just never show up because I'm here teaching. But I appreciate you. I do. I appreciate your hard work. I really do. Jokes aside, I sincerely appreciate your efforts in the course so far. It means a lot to me, and hopefully it means a lot to you as well, because hopefully you're getting a lot out of this. I know it's not. I know it's not easy, but the great thing is, you're able to take a lot of this stuff with you as you proceed with your degree. So that's why I do what I do, and that's why I'm happy that you're all doing so well so far. So again, if you ever need anything, you know how to get me. But thank you. I just want to take some time to say thank you to you, because it means a lot to me, and means a lot to you as well. Okay, let's jump into it. Let's talk about accounting for receivables. And I apologize that it did that. Hold on just a sec. Let me just change the display settings here. And oh my goodness, come on. There we go. Sorry about that. Got it. Yay. All right. All right. Accounting for receivables. Let's talk about this concept. Receivables. What is a receivable? Who can remind me what is an account receivable? Who'd like to tell me what an account receivable is? Remember? Account receivable. What do we think? Leland, what's an account receivable?
Um, isn't it when like you are receiving funds for you know things you give through like products or through service?
You got it. Yeah, exactly. So exactly right. So I made a sale of a product
Yeah.
or a service. The customer has not yet paid me.
Yeah.
I expect to receive payment in the future. That's what an account receivable is. Exactly. Thank you, Leland. Very good. Yeah, exactly. That's what an account receivable is. So that's one form of receivable. Of course, in business, it's the biggest form of a receivable, but we also have things like a note receivable. We also have, other types of receivables. Accounts receivable is when a customer owes us payment from the sale of a good or service that we made to the customer. The customer has not yet paid us for the good or the service. They owe us. That's an account receivable to the business. Yeah. So we're going to talk about that. We're going to talk about that at length, and a lot of different nuances about accounts receivable. We'll also talk about this concept called a notes receivable. Note receivable is kind of like you gave your customer a loan. What I mean by that is sometimes customers don't always pay us on time. And when they don't pay us on time, we might convert their account receivable into what we call a note receivable. And basically what that is we take their total accounts receivable and put it into the form of a short-term loan. And so that means we're charging our customer what they owe us plus interest, and with a fixed due date, etc. So we'll talk about these things. So as Leland described, an account receivable is when a customer owes us money for the sale of a good or service that we made to that customer. And we in business have a lot of different customers. Not just one, hopefully. Hopefully we have more than one customer. And sometimes more than one customer might owe us at the same time. So we have, and we talked about this before, we have our general ledger account, accounts receivable, shows us the total, right? The total amount. Within that, we have our subsidiary accounts. Remember? We talked about this, I think it was last week. We have subsidiary accounts, which represents our individual customers and what they owe us. Okay? So in accounts receivable, we have the total accounts receivable for the company. And then within that, we have our subsidiary ledgers, which is our individual customers that owe us. And those subsidiary ledgers show us the amount that they owe us. Okay. Here's a nice graphical representation of a lot of very well-known companies. And it represents their total accounts receivable. It's an interesting graphic. I had no idea that Nike made that many sales on accounts receivable. Yeah, interesting. So let's walk through a couple of examples of accounts receivable and the type of transactions that we would make using journal entries. So here we have our company made a sale of $950 to our customer. And we, on the same day, we also collected cash from a different customer for their account receivable. So we make two separate journal entries for this. Because remember, we need to record for our specific customers in order to track their individual receivables. So the first one, we made a sale to Comp Store in the amount of $950 on credit. When you hear the word on credit, we think accounts receivable. Okay, so we made a sale on credit to Comp Store. So we debit the accounts receivable for that customer, Comp Store, $950, and we credit sales. The second transaction is a separate customer is paying us. We're receiving payment from a prior sale for that customer. So we debit cash, $720, and we credit accounts receivable, RDA Electronics. That's the name of the customer. It's paying us. Yeah. So you'll notice that we always record the subsidiary ledger, right? Because that's how we track what's going on with that particular customer. So we recorded those two accounts. We post them, right, to our ledgers, and we can see that as we posted our transactions, what the effect is on our, going from our subsidiaries here on the right, flowing down, what's going on with our accounts receivable. Yeah. And it shows us the reflective balance for the total accounts receivable, general ledger. So on the left side, we got general ledger. On the right side, we got the subsidiary ledger accounts. Okay, here we have another example. July 15th. We made a credit sale. Credit card sales. We made credit card sales of $100. I briefly talked about this concept, I think it was last week, or it might have been the week before. We talked briefly about credit cards. Let's elaborate a little bit more on credit cards before we jump into this example. When you make a credit card sale to a customer, you swipe the card. Now, what happens when you swipe the card, you might ask? Funds are not automatic. Yeah, it's an EFT, electronic funds transfer, when you swipe the card. But here's how it works. When you swipe the card to make the sale to the customer, the credit card, there's a process that takes place. Okay? So you swipe the card, and at the end, remember we talked about this last week, we batch out the sales at the end of the night. What happens here is that at the end of the month, you get a bill from Visa, MasterCard, your credit card processing company sends you a bill, and it's for 4% of all of the transactions that you made with a credit card. Okay? We call this a credit card expense. It's a part of doing business if you're accepting credit cards. So I know that some of you in the class are small businesses, and so you might be accepting credit cards. I don't need to tell you this, but when you accept a credit card, you're going to pay 4% of the total transaction for swiping that card, for accepting it. So Visa, MasterCard, American Express, and even debit cards, all businesses have to pay a credit card fee for swiping that card. Okay, so if you're in business today, you're a small business, I want you to know this is normal. It's a part of doing business. If you're going to accept credit cards for sales that you're making, it's fine, but you need to know that there's fees involved. And these fees, they add up, of course. 4% is not a small amount. But I'm going to caution you, this is just me to be talking to the class, okay? I want you to know that in business, please don't pass this shit along to your customers. Okay? Don't be like, oh, I'm going to have to charge you an additional 4% because you're using a card. Don't do that.
That's trash.
That's a great way to alienate your customers. Exactly, Leon, you're right. That's trash. When I see that kind of thing, it makes me angry as a customer. I'm like, why are you charging me for? Just raise your price. So that way I, as a customer, don't know about it. Okay, I'd rather not know. I already know that the business has to pay 4% for accepting my credit card. You don't need to pass that along to me, the customer. You see? So, just a word of caution. If you're in business today, or you're planning on going into business, never, ever, ever pass this fee along to your customer. Just build it into the sales price. Okay? Please. Thank you. Okay, I'll get off my soapbox. Here's how it works. July 15th, our company made credit card sales of $100. There's a 4% fee for me accepting the credit card. So that means I receive $96 at the end of the night when I close my batch. Because $96 is 100 minus the 4%. With $100, obviously $4 is 4%. So the transaction the journal entry I make is debit cash $96, debit credit card expense $4, and credit sales $100. As you know, cash is a balance sheet account asset. Credit card expense, that's an expense on your income statement. It's a period expense. It just shows up on your income statement, okay? And sales, of course, that's on your income statement. That's the top line, right? Yeah, all Michelle, all corner of the market, the corner markets do the same thing. You're right. You're absolutely right about that. I see a lot of small businesses do it, and every time I see it, even I tell them, I'm like, just raise your prices. Don't be like that. It's a way to alienate customers. Right. So sometimes, unfortunately, in business, not all your customers are going to pay you. I know, right? Sometimes you sell something on accounts receivable, and you tell the customer, "Hey, pay me in 30 days. Here's your invoice. Pay me in 30 days." Sometimes they don't pay. 30 days goes by and nothing. So what happens? You send another invoice and it says past due. Okay? Another 30 days goes by, nothing. Now you're getting upset because your customer ain't paying you. And then you go, listen. So you start calling them. Hey, listen, what's going on here? Sometimes they're not going to answer the phone when you call them. Something happened. They disappeared. Oh, it's the worst. Worst feeling in business. Customer disappears, don't get paid. Oh, that sucks. That's the terrible part of doing business, not getting paid. So, in accounting, we have an answer for that. It's called a direct write-off. In business, if you don't get paid, you shouldn't be paying tax on that. Okay? On not receiving the revenue. You didn't receive the revenue, you didn't get paid. So, we write it off through what's called the direct write-off method, and I'm going to show you how that works. This is called a bad debt. Some customers ain't going to pay you. Okay, you're just not going to be able to collect for whatever reason. In business, we call that a bad debt. It's uncollectible. You're not going to be able to get that from your customer. Okay, two methods to writing this off. One's called the direct write-off method, and the other is called the allowance for doubtful accounts method. I'm going to show you what both of these look like. Direct write-off method is a method for us to directly write off the uncollectible account receivable for that customer. Okay. The way I like to think about it is I'm reversing that customer's account and I'm allocating it to bad debt expense. Okay. Here's the example. Our company determined on January 23rd, we're not going to be able to collect from our customer, Jay Kent. This guy disappeared. I can't find him. Okay? You're not paying us. Okay, that makes me feel bad. I don't know what happened to the customer. Maybe something happened to them. Oh, maybe they went out of business or whatever. Okay, so 3 days went by, nothing. 60 days went by, nothing. 90 days went by, nothing. Okay, there's a good chance we're not going to get paid. So we write it off. We debit bad debt expense $520. That's the amount that we're probably not going to collect. And we credit accounts receivable for that customer. Again, $520. Okay, that's what we call a direct write-off. or directly writing off for that account. Now let's say, miracle, okay, miracle happens. The customer woke up and said, oh my God, we owe Dr. B money, $520. Okay, great news. Customer woke up, now all of a sudden they're paying us. Great. So March 11th, customer came to life and said, oh, sorry about that. Didn't mean to not pay you the past 90 days. Here's the payment. So we have to fix that bad debt write-off because now we're getting paid, right? So the first transaction is we debit accounts receivable, we credit bad debt expense to reverse that earlier write-off. Okay. The second transaction is we debit cash, $520, receiving the cash from the customer. Credit account receivable, J10. This helps us record the payment for their account. Yeah, these things happen. This is a normal part of business. So in using the direct write-off method, I personally love the direct write-off method just because it's easy. Using this method, the expense recognition principle requires the expense to be reported in the same accounting period that the sale happened to help us to produce the sale. Simply put, expense recognition principle says that we have to match the expense with the revenue in the same year, the same accounting period, same month even, that the sale happened. So if 90 days goes by, I'm in the next year, I'm in 2024, this guy, Kent, never paid me, okay, back in 2023 when I made the sale in September. Never paid me. Okay, so what do? I record the journal entry for the last day in December because it has to match the same accounting period. That's what this tells us. And the second thing is materiality constraint permits direct write-off method if the result is approximate results using the allowance method. Simply put, if we use the direct write-off method, that means that we cannot use the estimation method or estimating the allowance for doubtful accounts method. You can only use one or the other. Yeah. I personally like this method, but it has its drawbacks. So we talked about the direct write-off method. It's probably the easiest one to understand. So now I want to show you the allowance for doubtful accounts method. You hear me use the word allowance for doubtful accounts. That's the actual name of the account. That's why you hear me use that phrase. So the allowance method, what I call it the allowance for doubtful accounts method. At the end of each period, we estimate the total bad debt expense based off of that period's sales. In other words, what we're doing here is we're saying, hey, I made $1 million in sales this year. I expect I'm not going to be able to receive 3% of that. Okay? So 3% of that $1 million, I'm not going to get. Because there's a great chance that not all of my customers are going to pay me. Some are going to default, or they just will disappear. They'll go out of business. They're going to be unreachable. They gave me a fake phone number, fake address, fake name. Life happens in business. So the allowance for doubtful accounts method, the way it works is we take our total sales and we estimate that a percentage of our sales is not going to be collectible. Okay, of our credit sales, for credit sale. Obviously, we're collecting cash over the counter, but sometimes our customers who on accounts receivable, we're not always going to be able to collect all of it. So we estimate it. Two advantages to using this method. Record the estimate in the accounting period it's related to. And the second advantage is we report account receivable on the balance sheet as an estimate of the amount of cash we expect to collect. Let's walk through the example. Our company, we had credit sales, meaning our sales on accounts receivable of $300,000 during the first year of business. At the end of the first year, we still didn't collect $20,000 of that $300,000. Based off of our business experience, we estimate that we won't be able to collect $1,500 of our total account receivable. So we make an estimate entry. Entry looks like this. We debit bad debt expense $1,500. And we credit an account called the allowance for doubtful accounts $1,500. This helps us to record the estimate of the bad debt expense based off of our experience. It's totally allowable to estimate sometimes in accounting. And this is one of those instances where we make an estimate. And of course, should this estimate be wrong, we'll make adjusting entries for that. So here's what it looks like on the balance sheet. We made the sales of $300,000. End of the year, $20,000 couldn't collect. We estimate $1,500 uncollectible. Here's what it looks like on the balance sheet. Accounts receivable is $20,000 minus allowance for doubtful accounts, $1,500, gives me total accounts receivable $18,500. Or you'll see it just read accounts receivable $18,500. Yeah. So let's say our same customer. Picking on this guy, right? Okay, here we go. Our company determined that our customer, J. Ken, he got to pay us $520. It's been 3 months. Can't try to contact the customer. Nothing's going on here. So, okay. So we estimate, we're not going to be able to collect from this customer. So we debit allowance for doubtful accounts $520. And we credit accounts receivable $520 for this customer. In this allowance for doubtful accounts, the write-off does not affect the realizable value of accounts receivable. What I mean by that is because we're using an estimate known as the allowance for doubtful accounts, it doesn't affect our total realizable accounts receivable balance. You see? Before the write-off, accounts receivable $20,000 minus allowance for doubtful accounts $18,500. After we've done the actual write-off, the realizable value of the accounts receivable is the same. Yeah, that's what we mean by this. Now let's say miracle again. Oh, Our customer came back to life and decided to pay us. Great, wonderful news. Where the hell you been, Jay Ken? It's only been 90 days. So the customer wakes up, okay? Now they're going to pay us. So we go through the process. We reverse the earlier write-off. Debit accounts receivable J. Kent, credit account allowance for doubtful accounts by 20. Then we receive the cash from the customer. Debit cash, credit accounts receivable. Yeah. It's the same way. It's just instead of using bad debt expense, it's allowance for doubtful accounts. So that's my presentation on the direct write-off method and the estimation approach along doubtful accounts. Now let's talk about how we estimate the uncollectible amount. As I had mentioned, a lot of times businesses apply a percent of sales. So in our earlier example, we made $300,000 in credit sales, and we said that, we're not going to be able to collect 3% of it. Okay, that's the percent method. Yeah. It's just a factor. It's an estimate based off of industry averages, etc. The second method to estimating the allowance for doubtful accounts is based off of the percentage of accounts receivable and the aging of accounts receivable. I'm going to show you what these look like in a lot more detail, okay? So first, the percent of sales method. Very easy, straightforward type of estimate. We take the current period sales from your income statement, and we multiply that by the bad debt percentage. The percentage is what we're estimating. 1%, 3%, maybe 5%. Yeah, it's an estimate percentage. We just try to estimate the percentage itself. So current sales times bad debt percentage equals the estimated bad debt expense. That makes sense. Now, using this method in our example, another example. Music Land, that sounds like fun, has credit sales of $400,000 in 2021. We estimate that 0.6% of our credit sales will not be collectible. Okay, no problem. So here's how this works. We take the, sorry, I didn't realize there was a random comma sitting there. That comma shouldn't be here. I don't know what happened there. 400,000, okay, not 4 million, 400,000 times 0.6, okay, gives us 2,400. So 2,400 is our estimate. We debit bad debt expense, 2,400, and we credit the allowance for doubtful accounts, 2,400. This records the estimated bad debt. You'll notice that we do it at the end of the year. This is because remember the matching principle. It has to be accounted for in the same year in which it occurred. Okay. So we take the year-end accounts receivable times the bad debt expense percentage. This is taken by the total estimated bad debt expense minus the previous balance in the allowance for doubtful accounts. equals the current bad debt expense. In other words, we are making an adjustment based off of the year-end results. This thing out of here. What's this doing? Okay. Looking at our example, Music Land. We have $50,000 in accounts receivable and $200 credit balance and allowance for doubtful accounts. 5% of receivables are not going to be collectible. So 50,000 times 5% equals 2,500. That's our ending balance. Of course, based off of this information, we have a $200 credit balance and allowance for doubtful accounts. So we take our estimate, 2,500, minus the credit balance and allowance for doubtful accounts. That gets us to 2,300. Again, it's a way of making kind of like an adjusting entry. Yep. Okay, so that's the percent method. Now let's talk about the second method. Okay. Aging of accounts receivable. This is one of my favorite reports in business. The reason for this is because aging for accounts receivable report shows me how old age, right? Each account receivable is. The older an account receivable is, the less chance I expect to receive it, right? In other words, the longer the account receivable goes uncollected, the less likely it is that you're going to collect it, right? Older it gets, the less likely it is that you're going to collect it. All right. So that's what the aging report for accounts receivable shows us. It classifies each receivable by how long it's past due. It groups them together based off of the age. 0 to 30, 31 to 60, 61 to 90, 91 to 120, 121 to 180, 181 plus. These are the age groups in terms of days that it's past due. Yeah. We estimate the bad debt for each group and we total them up. I'm going to show you what it looks like. This is what it is. I find this report very interesting. So check this out. Here we have a list of all our customers on the left. And we have their totals. We have total accounts receivable, 50,000. We have an estimate based off of our earlier projection, the percentages, right? We estimate we're not going to be able to collect 2,270. Well, where does that total come from? It comes from the aging report. And you'll notice that next to the totals, we have our age groups. We have not due yet. In other words, current. That's not due yet, it's current. And it shows us the customer totals that are not due yet. 5,890 for Charlie, 10,300 for Chavez. He's already $200 past due, so that's a concern. We got Zem services, 20,810. Total receivable for not due yet is 37,000. We expect that we're not going to be able to collect 2% of that. 2% of 37,000 is 740. And then we move into 1 to 30 days past due. And you'll see I have a couple of customers here that are 1 to 30 days past due. Add those all up together, you get 6,500. I expect that out of that 1 to 30 days past due, I'm not going to be able to collect 5% of that. Pretty reasonable. That gives me a total of $325. Then I do the same thing again, 31 to 60. Add up the total, 3,700. I'm not going to be able to collect 10% of that. 31 to 60 means we're talking 2 months old. 370 I'm not going to be able to collect. 61 to 90. $1,900 and 61 to 90 past due. 25% of that, there's no way I'm going to be able to collect 25% of that. So 475 is my estimate for that group. 90 days plus. So this percentage is kind of low in my opinion. But $900 is 90 days past due. Not 3 months you didn't pay? That's 40% of that I'm not going to be able to collect. So that gives me an estimate of 360. If it were me, it'd be a lot higher than 40%. Because and there's other categories beyond this, but I'm just showing you, what it looks like and how it works. But 91 to 120 is usually what that category is. 121 plus. Once it reaches 120 days past due, you ain't gonna see none of that. That person's gone. But I'm just trying to show you what this aging report looks like, how it works. So you'll notice that the older the account receivable gets, the less likely it is that we're going to be able to collect it. That's why we have a higher percentage of uncollectible the older that it gets. That's what I'm trying to show you. So we add all of those together to get to the $2,070. Well, it's technically $2,270, right? But we had a balance of $200. So remember, we subtract that balance out. Yeah. Get to $2,070. We debit bad debt expense and credit allowance for doubtful accounts at the end of the year to record the estimated bad debt expense. Is all this making sense? You all feeling pretty good about this so far? Leland, we doing okay?
Yeah, I was gonna ask a question, but it's kind of self-explanatory.
You sure?
I was gonna ask, why keep track of all the people that kind of like scammed you out of money?
Yeah, that's a good question. So, when customers don't pay us, we got to know how much they didn't pay us by, so that way we can write it off.
Okay.
We have to lower our account receivable by that amount that we didn't get paid by, because ultimately, Leland, you don't want to be paying taxes on a sale that you didn't collect on.
Exactly. I mean? So you can write that off, that because it's like, okay, I gave them a service, but I didn't get my money for the service. Exactly. So you have to write that off. Okay, so you got to record all the transactions where people just ran.
You got it. Exactly right. Yeah. Okay. Good question. Very good question. Yeah. That'll be good. And then, of course, as time goes forward, we make adjustments accordingly. We've received some from customers, so we make adjustments. Yeah. So, in summary, when it comes to making these estimates, the bad debt estimation is going to impact both your income statement and your balance sheet. Because, as you know, income statement, we have our sales. Balance sheet, we have our account receivable. So, it's going to impact both of those. And this is the flow chart that explains the impact on both your income statement and your balance sheet. Okay, so that's estimating bad debts and things like that. Now, let's say we got a customer, Ken, who hasn't paid us in 90 days. Okay, for me, that drives me crazy. A customer doesn't pay me that long. I'll probably pay them a visit. Yeah. But besides that, oftentimes what a business will do is they'll call the customer up and say, hey, customer, you didn't pay me in the past 90 days. What's going on with you? And they'll say, oh, sorry about that, blah, blah, blah. And you'll say, okay, no problem. Here's what we're going to do. We're going to start charging you interest for being so late. So what we'll do is we'll convert your account receivable into a note receivable, meaning you're adding an interest and a final due date. And of course, all that's going to be based off of what we call a promissory note. It's a promise to pay. So a note receivable includes a promissory note, which is where the buyer of your product that you sold them agrees to pay you at a specific day in the future with a specific amount. The amount includes interest. Okay? They sign this agreement. The agreement's called a promissory note. Yeah? It's a promise to pay.
So do you do this for customers that you don't really trust that's going to pay you when you need to pay? So you
No, it's a customer that I don't already trust because they didn't pay me to begin with.
exactly.
Yeah, exactly. Yeah. Yeah, very true. Yeah, yeah. A promissory note is very common. If any of you have student loans, you signed one of these promissory notes. I know you did, right? Because that's how student loans work. When you take out the loan, you sign a promissory note. It's a promise to pay the bank back. Yep. Works the same way. The only difference is that type of promissory note, like for a student loan, that's long term. Yeah. Uh, so the maturity date. Maturity date is a term that we use that means due date. Maturity date is when it's due. It means the same thing. The interest and the principal balance need to be paid on the maturity date, also known as the date. Okay. So here we have an example. Our company received a $1,000 90-day 12% interest promissory note as a result of a sale to our customer, Julia, and she didn't pay us, okay, like 90 days. So we got her on a promissory note, all right? Shows us $1,000. We give her another 90 days and 12% interest. Ooh, that stings a little bit, doesn't it? But it encourages her to pay us. So we have to figure out what the due date is. So how do we do that? We do what's called computing the maturity date process. And here's how we do that. July 10th is when the promissory note was signed. Okay? There are 31 days in the month of July. We take 10 days out of that. That gives us 21 days remaining in July. There are 31 days in August. There are 30 days in September. Yeah. So we add 21 plus 31 plus 30 plus the remaining balance of 8 days in the month of October. That means that Julia has to pay us on October 8th. That's a total of 90 days, right? That's how we figure out the due date, the maturity date. So on August 8th, Julia's got to pay up. How do we figure out how much interest we're going to receive from Julia? Use what's called the interest computation. The formula here is we take the principal of the note. Principal is a word we use to mean face value. Face value and principal, they mean the same thing. Okay. In this case, it's $1,000. That's the original balance. Yeah, $1,000. Times the annual interest rate, 12%. We said it was 12%, it's 12%. Annual interest rate is 12%. It's annualized. Even for maturities less than 1 year, it's at an annualized rate. Okay, 12%. Times time. T-I-M, times, T-I-M-E-S, time, T-I-M-E, amount of time. So principal balance, $1,000, times interest rate, 12%, times time, 90 days. Now, here's what I want you to understand. Time is expressed in a fraction of a year. There are 360 days in a year. Wait, I can already hear you. After B, there's 365. Sometimes 366. But I leap year. There are 360 banking days in a calendar year. These banks open 360 days out of the year. That's what that means. Okay. So we use what's called the banker's rule. Banks open 360 days a year, so we use 360. So to express time, we take the number of days, 90 days in this case, divided by 360 calendar banking days in a year. 1,000 times 12% times 90 over 360. I know it's complicated stuff. Do the 90 over 360 part first. Pretend there's parentheses around it. That gets us 0.25. So 1,000 times 0.12, also known as 12%, times 0.25, which is 90 over 360. The total interest that Julia's going to pay us is $30. Okay, that's how we figure out how much interest we're going to receive. On July 10th, when we made the promissory note with Julia, we record that in a transaction on July 10th. We debit notes receivable, Julia, $1,000. And we credit sales, $1,000. Now, on October 5th, this is a different customer. October 5th, we had a customer that paid us in part cash and the rest of it through note receivable. We made an agreement with this customer. They said, hey, we don't have that much cash on hand. We'll give you a little bit. We'll give you the rest later through note receivable. Okay, cool. So here's how that looks. We debit cash, the amount of cash that the customer gave us, $232. We debit note receivable. The note receivable says they're going to pay us $600 within 60 days, so 2 months. 15% interest. Steep. From our cook to settle her account. It's $830 past due. Oh, dang. So she's trying to, satisfy us. So she gives us a little cash, give us the rest later through note receivable. So debit cash, $232. Debit note receivable, $600. Credit the customer's account receivable account, $832. Hopefully she pays us, right? Sometimes they don't pay us, even with note. When a customer pays you with the note on time, on the maturity date, it's called honoring the note. If the maturity date passes and they don't pay you, it's called dishonoring the note. Okay, so when the note is honored, they pay at the maturity date. Here's how it looks. So Joe, she decided, hey, we're going to pay you on time, 60 days, 15%, $600, pay you on time, December 4th. So she pays. We debit cash, $615. 15% of 600, 60 days. Remember the math, right? It's principal, 600, times 15%, times number of days over 360. Number of days, 60 over 360. Do that part first. Yeah? So it's $15 interest. So debit cash, 615. We credit notes receivable, 600 for the customer. And we credit interest revenue, $15. You'll notice it says interest revenue. Interest revenue is a revenue account, sales account, technically. Because it's interest that you're receiving that you would otherwise not normally receive in day-to-day operations of the business. The same account, interest revenue, you'd use that same account. Let's say you had like a high yield checking or savings account. Same thing. Works the same way. Let's say Julia didn't pay us, or Joe didn't pay us. Oh my goodness, what happened? The 60 days went by, you didn't pay me. That makes me upset. So, a couple of things need to happen. Since the note was dishonored, we need to reverse it. We're putting it back onto our account receivable. But you better believe we're adding the interest onto that account receivable as well. We debit account receivable for the customer, $615. Credit interest revenue, $15, because we're still going to get that interest. And we credit note receivable, $600, to reverse the note receivable. What makes you feel bad when they don't pay? Okay, let's say that you have a customer that did a note receivable with you, and it went over the end of the year, right? It's like, oh, we made the agreement in the month of December. It carried through February. Okay, so what do? You make an interesting entry at the end of the year, because remember, according to the matching principle, we have to recognize the revenue and expenses when they were incurred during the same accounting period when they happened. Yeah. So here we have an example. December 16th, we made an agreement with a customer for a $3,000 promissory note receivable, for 60 days, 12% interest. Okay, I did this on December 16th. All right. This satisfies their past due account. So we got to figure out how much interest we're receiving in this year and how much we'll receive next year, according to the matching principle, right? So how do we do that? We take the face value, 3,000, times the interest rate, 0.12, 12%, times 15 days out of 360. Why 15 days and not the full 60 days, you might ask? Because the agreement was made on December 16th. There's 31 days in December, which means there's 15 days in December we got to account for. So 15 over 360 times the 0.12 times the 3,000 is $15 of interest that we need to record for this year. You see? So again, it's adjusting entry. And then, of course, the remainder would be recorded in the next year. So at the end of the term, customer pays us cash $3,060. How $360, you ask? Well, we already had the $15 from December, $45 from the rest, January 1 to February 14th. We do that by finding the number of days that covers. We apply the same principle, you see. How many credit notes received? It's adjusting entries, right? Very straightforward. So sometimes you get lucky. Customer pays you before the maturity date of the note. That's great. Okay, they paid you early. Awesome. So, you record that accordingly. So when that happens, we do for the this is the type of transactions we make. Now, sometimes company might sell their account receivable to a collection agency. Yeah, oh yeah. Hey, we've all been there. At some point in our lives, I'm sure we have. I know I have. So sometimes you forget about a bill. It goes for a minute. And they send you a couple letters and you file that in the circular file, And so then they start calling you, pretend you're not there, pretend you don't speak English, the usual stuff. And then eventually they're like, hey, you gotta pay us. Otherwise we send you to collections. You're like, fine, I don't care. Send me to collections. They send you to collections. What the company's doing, they're still getting paid. Okay? But now it's your bills with another company. So how does that work, you might ask? So glad you asked. Let's say we're Macy's, okay? And sometimes customers don't always pay Macy's what they owe. So what happens is Macy's will sell their account receivable to a collection agency. Of course, they take a hit on that. They're not going to get the full amount. Oh, no. So let's say you owed Macy's $20,000. Macy's turns around and they're like, we're going to sell that account receivable for $9,200. It's less than what they would have gotten from you, but they're still getting something. Okay, we call that factoring. It's a way to mitigate the risk. Okay, so basically the company's just selling it to a collection agency. Macy's still receives $9,200. They write off the $20,000, and the rest of it's allocated to what we call factoring fee expense. So another way that they might do it is called pledging accounts receivable. It's basically securing the note with the customer, backing it up. They usually back it up with like a actual loan from a bank. Just a couple of interesting methods. One ratio that we use to figure out how quickly we can collect from our customers is called the account receivable turnover ratio. How quickly can I collect from my customer on average? And to find that, we take our net sales from our income statement divided by average account receivable. There's that word average again. Dr. B, what's average mean in accounting? Average is where we take the beginning balance plus the ending balance divided by 2. Okay, that gives you the average. So beginning balance accounts receivable, beginning of the year, plus the ending balance accounts receivable, end of the year, divided by 2. Gives you the average, yeah. Average accounts receivable. How quickly I can collect my custom. So that is our discussion on accounts receivable and other receivables. Any questions at all on receivables that y'all can think about that, maybe I could do a better job answering, or did we do okay with the receivables?
Yeah, yeah, it's for all the scumbags that don't want to pay. Got it.
Yeah, exactly.
I actually had a question, Dr. B.
Yeah, please go for it.
Um, Notes receivable in the interest, is that the same thing as customers we hear that late fee, or are those two different concepts?
Those are two different concepts.
Okay.
So a late fee is just a fee that they add on to the account receivable. Yeah. With a note receivable, it's the customer hasn't paid in a real long time,
Mhm.
and the company chases them down and says, "Hey, listen, we're going to convert it to a note, also known as a short-term loan," and that's where they tack on interest and a specific due date. Yeah, that's the difference between those two.
Okay, no, thanks.
Great question. Absolutely. Any comments, questions, concerns on accounts receivable? Going once, going twice. Okay, cool. So that's accounts receivable. Let's jump into the next conversation, which is on property, plant, and equipment. So let me stop this part of the recording. Then we'll jump into property, plant, and equipment. So please stand by for the next step. Thank you.